This week on Wealth Track, why two value investors who have weathered the market storms are now expecting calmer seas, but keeping some sails trimmed just in case. Polaris Capital Management's Bernard Horn and Thunderstorm Capital's John Dorfman on their search for global value are next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Are we on the road to a back to normal market? That is the view of this week's Wealth Track guests. Both are seasoned value investors who believe there are opportunities galore in global markets. Individual investors, however, are not buying it. They have been net sellers of stocks and net buyers of bonds for months. They are still psychologically damaged from their experience of the last decade. A couple of charts provided to me by David Darst, Morgan Stanley's chief investment strategist and asset allocation guru, illustrate why. Take a look at what investors experience with U.S. financial stocks. On a total return basis, with dividends included, the Dow Jones U.S. Financials Index increased five-fold from the mid-90s to 2006, only to plummet 76% from peak to trough during the financial correction. Then there's the performance of a so-called defensive stock group, drug companies. Darst's chart notes that from 1994 to 2000, the Dow Jones U.S. Pharmaceuticals Index increased nearly sevenfold with dividends included. From their peak in the beginning of this decade to their trough in 2009, they fell 56%, disconcerting to say the least. Is it any wonder that individuals are leery of stocks? Well, these are exactly the times when veteran investors find long-term value. This week's Wealth Track guests are seasoned practitioners of the art. Bernard Horn is president and portfolio manager of Polaris Capital Management, from which he runs the Polaris Global Value Fund, a finalist for Morningstar's 2006 International Stock Manager of the Year Award, among several other recognitions for his long-term track record. Horn uses both fundamental and quantitative analysis to scour the globe for value. John Dorfman, chairman of Thunderstorm Capital, has been managing individual and institutional portfolios at his firm since 2000, far outpacing the markets in the process. John was a colleague of mine many years ago at the Wall Street Journal before switching into money management, where he worked for several years with legendary value investor David Dreman before founding Thunderstorm Capital. He continues to write a syndicated column. I began the interview by asking Bernie Horn why he felt we were finally returning to a back-to-normal market.
A normal market in statistical terms, without getting too technical for your listeners, means that you've got sort of a bell-shaped curve of stock performance with the right-hand side kind of stretched out a little bit. So you have a few really good returns and then kind of things go up and down. And any given year, you'd expect to have a return of about 6% after inflation, plus or minus 20%. Now, that's normal. Okay, so what's not normal? Basically, the period from the early 90s through 2006, when markets kind of were very powerfully going up almost all the time, that's a little bit abnormal.
And that's the kind of markets that we all loved, of course.
Because most investors remember the thing that's most recent, and quite frankly, that was a very long period of time, more than a decade. If that's your experience in the market, you think that that's just going to continue forever. You know what? It doesn't. And right now we have a market where things not only can go up, but they can go down. And we have a business cycle, and we have a lot of other things in the economy worldwide that are kind of driving expectations and greed and fear up and down. So I think this is a very normal market, and quite frankly, for value investors, this is a great market.
So, John, what's your take on are we in a back to normal market?
Well, I think we're still locked into the fear quadrant right now. After the great period that Bernie just described, we then had, well, we had a decade from, the aughts from 2000 to 2009, where the market declined close to 1% a year. And
that's
not typical.
Normal, right?
No, that's
right.
not normal either. Mm-hmm. And it was partly, two sides of the same coin. The great returns of the 80s and 90s led to the subpar returns because we really got overvalued in 2002. Stocks were selling at 30, 31, 32 times earnings. That was a lot to correct. And now we've corrected it, but investors are still, I feel, frozen in fear. So I do think that, over most long periods, the market has returned in nominal terms, 9 to 10, 11%
right,
a year.
In real terms, 6%, as Bernie said. Yeah,
exactly. And I think we will get back to that now.
We are getting back to that now. You think that's what we're for? What about volatility? The kind of volatility that we've seen, this risk-on, risk-off market. Are we going to see the kind of fat tails, as they say, the extremes of up and down markets in very short periods of time? Bernie, is that something we've got to learn to live with as well?
I think, again, it's probably part of the normal fluctuations in markets. And I think what people are afraid of is that this whole concept of risk on, risk off means that all things go up and down at the same time. And there's a little bit of that goes on in certain sub-periods during the year or the quarters or the weeks. You'll have spikes of correlations, and then they kind of dissipate as the underlying economy continues to kind of drive valuations.
So, John, volatility, is that just a way of life now, or what?
It usually is a way of life. We had a couple of years of low volatility, and everyone wishes that were the norm, but it's not. And I think we'll see volatility in 2012 and in 2013. We had a nice first quarter in 2012, and I wouldn't be surprised if by September we were back to zero. We'll get Congress on display showing its statesmanship as it wrestles with the budget, and that will not make investors happy. We also, in 2013, will have the yanking away of a very substantial fiscal stimulus that you've had the last couple of years. So I think there'll be a lot of volatility in 2012 and 2013, but that doesn't necessarily mean that they will be down years for the year as a whole.
So, Bernie, one of the things that you said earlier, which caught my attention, was that it's a great market for value investors. How so?
A couple of reasons. Whenever you do have volatility, it means that when things go down, they may go down more than the actual performance of the cash flows are really going to go down in the future. And so whenever you have that mismatch where the value of the firm doesn't really reflect the true cash flow earning power of that company, that's the investment opportunity. We have this schizophrenic relationship with volatility. We want things to go down so that they're cheap enough for us to buy. On the other hand, nobody wants their portfolio to go down. So we just kind of have to live with this volatility. And quite frankly, if one expects the volatility and you change your thinking to say, okay, I know something is going to happen and it may be bad, and just kind of wait for it and be very patient about it, then you can say, oh, gee, this is a great opportunity to buy. That's the way we think of the world.
You're both value investors. And so, John, in addition to volatility, which can create prices that are lower than what a company should be selling for, what are some of the other things that you look for in the market on a kind of a day-to-day basis?
Well, in simple terms, we love to try to buy good companies on bad news. And people overreact to recent events. They overreact to salient events that make a big impression on them.
So you look for bad news. And I have to ask you, John, there are many screens that you use, but that there are a couple of screens that you've told me about, speaking of kind of bad news. And, and one of them is the low PE outlier stocks, is some research that you've done. Do you want to tell us about that?
Sure. For about a dozen years, I've been tracking the very lowest PEs in the market among stocks of a certain size and whose debt does not exceed equity. And you have a several hundred-fold return on these stocks over that period, despite a gigantic decline in 2008. Now, these are risky stocks, and they're risky stocks whose problems are usually very well known. I wouldn't advise someone to go out and make a whole portfolio out of these stocks because they tend to be clustered in certain industries and so on. But we just find it forces us to look at some stocks that are very highly unpopular. And there's a lot of academic literature showing that the bottom quintile, the bottom decile by PE outperforms the rest of the market.
And Bernie, I know that you're both a quantitative analyst and a fundamental analyst as well, and you screen 33,000 stocks at any given time. So what are the kinds of things that you look for? I mean, what's your definition of the search for value?
We have a very strict definition of value discipline, and that is that a company, for us, has to be priced so that our expected return on it is going to exceed the normal expected return on an index fund. So if an investor wants to kind of keep even with the market, they should put their money in an index fund, and our job, of course, is to beat that return.
So the normal expected return of an index fund would be
6% after inflation over long periods of time. So for us, why would we buy a company that is priced to give us a 6% return? Investors don't need that don't need us for that. They just go buy an index fund. So the only time that a company makes sense to look at for us is when it's priced below the expected value of the future cash flow in such a way that it gives us an expected return that's higher than that 6%. And we have various ways of doing that across the 100 or so countries that we can invest in.
Now, what's interesting is that when I talked to you earlier, you said of those 33,000 some odd companies that you screen, that you're looking at now a universe of about 2,000 that really represent true value, and that's 2 or 3 times. I mean, the normal is like 500 stocks at any given time. So what's going on? Why is the market creating so much value now, and where is that value being created?
Well, that's a good question. So really, since the end of 2008, the markets took a 2 or 3 standard deviation event. They were down 40, 50%, and that created a lot of opportunities. Prior to that, on our normal screens, we'd get 400 or 500 companies. Now we're getting 1,900, 2,000 companies, and it's really persisted since 2008. So a couple of reasons for that. One, investors remain pretty fearful. Anytime you have kind of a down quarter of market like we did in the third quarter of 2011, it just hits on that nerve that everybody felt so raw in the crash in 2008 and early 2009. So investors really are reluctant to bid up prices of stocks to level. So those remain good value. As far as where the values are in the world, it's really scattered about the world. As far as the size of companies are concerned, the mega cap stocks that everybody's putting money into, typically they are not the most undervalued companies in the world.
Even now, because most value investors I talk to are saying it's those mega cap, U.S.-based companies with emerging market exposure that are the greatest value today.
Right. We certainly have mega cap stocks in our screens, but they're not dominated by mega cap stocks. Mm-hmm. If you look at the growth of the world and the investment opportunities, it's really occurred over the last 10 years in the companies that are, $2 to $5 billion of size and lower. So that's where there are a lot of new companies because they've just been created. China, India, Brazil, and so forth.
And 2/3 of these 2,000 names are international stocks, right? They're not U.S. based, or
absolutely.
Mm-hmm.
The new growth in the world economy going forward for the next 25 or 30 years is going to be kind of outside the developed world. And as we know, lots of small and medium-sized companies, that's where the job growth is created. That's where the disruptive technology comes. And, so that's where, we see there to be future opportunity. But most of these companies are just not well followed. They're very, very good value. These are the sectors. So the small, medium-sized companies are great value. Of course, financials have been, really beat up pretty badly.
Yes.
A lot of good values there. Some of the Scandinavian banks, for instance, that have kind of been thrown out with the bathwater, have really sailed through this without any credit problems to speak of. And they are collecting a lot of the deposits that are being withdrawn from some of the other European banks. So they really represent not only companies that have good funding sources, but they also represent great value.
So, John, small, mid-cap banks, European, I mean, are these areas that you're investing in, or?
Well, I typically prefer small and mid caps because they're less followed. There's more of an opportunity to find an undiscovered gem. The past year and a half, I've found more values than I usually do among the big caps because small caps had run up so much in the preceding dozen years. One industry I like a lot right now is auto and auto-related because it's on the comeback trail and people aren't willing to believe it yet. You know, everyone is so skittish, as Bernie pointed out. You know, car sales have climbed back to about 14 million a year, car and truck sales in the U.S. 18 million was the highest we ever got. We were down to about 8 million during the depths of the worst times. And the news has been coming in well. And
the companies just aren't reflecting it?
The stocks are not really reflecting it, and people still think of them as having all the problems they used to have when those problems have been partially ameliorated. The legacy healthcare costs, the excessive labor costs, those have been ameliorated for the auto companies, including for General Motors through its bankruptcy. So that's one that appeared on the screen you were talking about a few days ago. We own it for clients. It was weak last year, but has been coming back strongly this year.
So that's one of the low PE stocks. Mm-hmm. You've got another screen as well, which talks about, it really speaks to where the herd is going, and that's one that you compared and have over the last 12 or so years, the most loved stocks by analysts and the most hated stocks by analysts. What does that screen show?
The lesson I hope people will draw from this is that they should do their own independent research and not rely on analysts to pick their stocks for them. When analysts herd, they typically do not create value. I've looked for about the last dozen years, every January at the beginning of the year, at the 4 stocks analysts love most and the 4 that they hate most. And those that they love most have severely underperformed the market and have been beaten by those that they hate most. But both groups, the loved and the hated, have underperformed the S&P 500. So if you see 12 analysts unanimously recommend a stock and there are no dissenting votes, or if you see 5 or 6 analysts say to sell a stock, you never get much more than that because Wall Street doesn't like to do sell recommendations. If you see, unanimous sell recommendations, neither of those is really a good sign. I actually look for stocks where opinion is mixed, where there's a difference of opinion. Because the truth ultimately is not going to be an average. The truth is independent of how many people believe it.
So, John, what is your sense of the value that is available in the market today to long-term value investors?
I think there certainly is value. I'm not finding as many values as Bernie is because my portfolios are more concentrated in the United States. I like some of the golds. I think some of the pharmaceutical companies are undervalued.
So let me stop you on the golds. These are gold mining stocks.
People love ETFs that own gold.
Yes, GLD, for instance,
yes,
right.
GLD foremost. Those ETF companies have to buy the physical gold and they have to buy it from someone. The mining stocks have not kept pace with the price of gold by any means for a number of reasons. But I think that's been true to an extent that now creates an opportunity where typically companies like Newmont and Barrick, both of which we own, have a glamour premium associated with them, and you're paying 22, 25, 29 times earnings to own these stocks. Well, right now you can get both of those stocks for under 15 times earnings. So the glamour premium has been rubbed off because the gold stocks have not performed as well as the metal. So I think this is a good time, personally, to buy those big producers.
Gold stocks. Any mining stocks? Any thoughts on those, Bernie? Is that an area that's showing up in your screens, or?
We do like mining stocks in general, but we're even more excited about, generally speaking, materials companies. I certainly would agree with John on the fact that the gold mining companies are a much better value than gold itself. We clearly see the materials sector as being a very interesting microcosm of what's going on in the world, the global economy as a whole, because you have the developing world, just the sheer weight of a couple of billion people in China and India against the weight of the 300 million people in the U.S. and a few hundred million people in Europe. The demand that this large population base has on the world's supply of raw materials is just pushing the prices of those up as they advance their economies.
What lessons did you learn from the financial crisis? Are you doing anything differently, John, than you did before?
We had more health care than we normally do. We had more utilities than we normally do because we normally don't have any. And we had more cash than we normally do, 15%, which for me, I thought was huge. I think, if I ever, God forbid, again, see signs on the wall like we were seeing in late 2007, early 2008, I'd probably do more of those kinds of defensive maneuvers.
Any lessons that you learned and that you're applying today, Bernie?
You always go through an experience like that and learn something from it. So we're mixing a lot more healthcare companies into the portfolio now, looking for inconsistencies in market logic, like the large pharma stocks are trading lower because there's a patent cliff and all their drugs are going to go generic.
Right, that's what's out there. That's the theory that's out there.
That's the fear that's creating all these values in large pharma, branded pharma stocks.
How important are dividends to you, Bernie? Is that part of this calculation as well, and is it an important one or not?
I think that the whole concept of a dividend, which is a share of a company's cash flow, is critically important. I think people have to really understand that, because companies can raise prices over time. And that way they can keep the real value of their cash flow growing. And to the degree that an investor can participate in that, or just the concept of it, is really critically important for people to understand, compared to a 10-year government bond, which has a fixed interest payment for 10 years. Because think of an investor aged 60. The average life expectancy is 85, and with technology and healthcare and the miracles of modern medicine, it's not unusual for us to expect that people could live into their 90s. So if you're 60, you have a 30-year investment horizon. Think of what has transpired since you were 30 leading up to age 60. There's a long-term investment horizon, and especially with interest rates where they are right now. I mean, when I got into the business in 1980, I had a lot of widows come to me with their investment portfolio that had been, bonds that had been purchased at 3 or 4 or 5% interest in the 60s,
right.
And then interest rates went way up into double digits. Their bond portfolios were absolutely decimated.
Do you want to add anything to that, John?
The only thing I'd add is that dividends have another useful purpose, besides the fact that they can grow over time and they make an important contribution to total return, and that is they're a good sincerity barometer. 90% of managements talk bullish, but if they mean it, then the board of directors should be willing to, preserve or expand the dividend. It's a good indication that they believe in the sustainability of their own company's earnings.
In that respect, do you look for companies that are paying dividends? Is that an important marker for you as well?
It is one of the things we look for, and it's sort of one of our decision entry points in some cases. For example, Johnson & Johnson and Intel, rising dividends were an important thing that led us to hold those two stocks.
So let me ask each of you for the one investment for a long-term diversified portfolio. And John, I might as well start with you.
I'll do Newmont Gold, Consuelo, because in addition to the arguments for gold made earlier in this program, governments on both sides of the Atlantic are printing a lot of money and will have to continue to for the next several years. Whether all the decisions that led to this were wise or unwise is beside the point. They are printing a lot of money. They will continue to print a lot of money. A certain number of investors are going to lose faith in paper currencies, including both the euro and the dollar. And this will be experienced by us as, oh, look, the price of gold is rising. We won't experience it as, look, the dollar is falling, because we're not as aware of that. It's like a fish being aware of water. But what we'll notice is that the price of gold is rising because people have lost some faith in paper currencies. So for a 5 or 10 year horizon, I think Newmont is the one I would pick.
All right. Bernie?
I would go back to my earlier comment, which is that the demographics and in the healthcare business really are pretty powerful. And a company like Teva Pharmaceutical, which not only has great generic exposure, but also has a budding branded product line, will be a great place to put some money for a while. It's very good value. It's got an awful lot of growth, and you're not really paying for it at this point.
So Bernie Horn, it's great to have you here. Thank you so much for joining us on Wealth Track. And John Dorfman, it's wonderful to have you on Wealth Track as well. At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is consider some simple rules of investing that have been successfully applied by this week's Wealth Track guests. Contrarian John Dorfman buys good companies on bad news and regularly looks at out-of-favor companies for investment ideas. Bernie Horn looks for opportunities internationally, especially in emerging markets, and focuses on smaller companies because that's where the growth is. Simple tips for successful long-term investing. Next week on Wealth Track, we will be talking to financial thought leader Jim Bianco, who regularly challenges the conventional wisdom on Wall Street. We'll find out what myths he is shattering now. If you want to see our Wealth Track interviews ahead of the pack, subscribers can do so 48 hours in advance. To sign up, go to our website, wealthtrack.com. You can also watch previous shows and find past One Investment and Action Point recommendations there. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.